Hello and welcome to Securities Lending Saturday. I'm Roy Zimmerhansl and I'm your host. This is the place to learn about the fundamentals of securities lending. Today we're going to talk about risk. This is the second in a two-part series. So if you haven't watched the first one, I recommend you do that. We'll put a link in the show notes, or you can go to the fundamentals playlist on our YouTube channel. The way that we do things here is that this will be live on LinkedIn, on YouTube, and on Facebook. But because it's hard to find things on Facebook and LinkedIn, we will we'll actually cut it so that the first 10 minutes will be available on LinkedIn and Facebook, but the whole episode will be in that fundamentals playlist that's available on YouTube right now. So, without any further ado, what I'll do is I'll just get set up so that I can get my slides. I've always got a handy deck of slides to go with the show. What I'm also doing though is you can download the slides every week by signing up to the weekly download. That'll be in the show description after we put it up. So if you like these notes, you will be able to download them, so you don't need to take notes here unless you so choose to. Right, I'm just going to share my screen right now so I can bring up the flashy red lights of risk, because securities lending is part of investment markets and it generates a return. And we know that anytime that you generate returns in markets, there's an element of risk. So that's what we'll talk about today. As I said, this is part two. The first part was last week. We really concentrated very much on counterparty risk last week. Today, we'll briefly touch on that, but we'll talk about 5 other risks that I've identified in securities lending. So uh, let's just get straight to it then. If you are watching and thanks very much. I can't actually see where you're actually watching from, but thanks very much for the comment from whoever the LinkedIn viewer is that said that they are here. So thanks, bro. Appreciate you actually being with us. So what we're going to talk about today, well, this is the past. This is what we've covered so far. Again, all of that will be in the fundamentals playlist. Today, we will be talking about, as we said, part 2 of risk. And then next week, we're going to come in with the half year stats, right? We're in the second half of the year. So I thought next week we'd take a little bit of a break from what can sometimes be a grind with all of this detail and just look at some numbers and take a look and see where the revenues are coming from and whether this is a good half year or a bad half year. Without really having too much of a spoiler, this is a better year than last year. So why don't you have a look at next week and see just how much better and maybe why. Right, again, why are we doing 2 sessions on risk? Well, as I said, in markets where there's revenue, there's associated risk. And so you should never do anything until you understand the risks that are involved in generating that revenue. Now, I think securities lending, if it's properly conducted, is a relatively low risk business. But you need to make certain you're covering all of your bases and understand what those risks are before you make a decision. And again, this is not any kind of professional advice before taking any kind of action. Um, Before you take any kind of action, what you should do is speak with an expert and get their advice. Consultants, tax advisors, investment advisors, so market professionals are all worth touching base with. But just like the motorcycles that are on display here, there are ways to put mechanisms in place. There are processes, there are practices, and all of these things can mitigate the risk so that your likelihood of loss is dramatically reduced. Right. This is what we're going to be talking about in part eight: six risks: counterparty, regulatory, markets, legal, operational, and of course, reputation. So let me just go through these very quickly. These are the ones we talked about, and we will provide an explanation of each and some of the key mitigants during our conversation today. But before I go through that, I just want to let you know I've got an upcoming video, which is a special edition, which says how to lose money in securities lending. I bet you didn't realize that I'd be doing a tutorial that would be able to tell you how to lose money. Maybe that's a little bit misleading because it's how you can lose money and how you can mitigate the likelihood or reduce the likelihood of that happening. So I'll be doing a video on that very shortly. This is, as I said, episode 8 of this series. So if you find these episodes helpful, please subscribe and ring the bell so that you'll be able to hear about the next video that we do, including that one that I just talked about on how to lose money in securities lending. Right. Very briefly, again, counterparty risk, to me, the single biggest risk for anyone involved in securities lending. Because if you're dealing with a counterparty that is ongoing in business, then the worst that could happen, and it's not a good thing, but the worst thing that could happen is that they renege on their contractual obligations, in which case, if they're still in business, you always have recourse to the courts. So if you pick the right counterparties and they're still in business, then that is your best protection against any kind of future loss. So we want to talk about counterparty risk itself, but something I alluded to last week, which is something called an indemnification. And an indemnification is provided by some of the lending intermediaries to their lending clients. And what it is it's an extra layer of protection for those lenders against a counterparty defaulting. So it's kind of like that umbrella there protecting the family from the rain. It's that extra layer of protection. Now, what does it actually do? Well, imagine there's a loss like Lehman Brothers. Now, in a normal loss, what would happen is when a counterparty goes into default rather than loss, you would take that collateral that you hold and you sell it and you buy back the securities that you loaned to that counterparty. And it kind of puts you back in the same position that you were when you started the lending program. So that's how you want to get there. But what if the market has moved since the last time you valued the securities you loaned to that defaulting entity and the value of the collateral that you were holding as protection? What if the market moved and all of a sudden the sale proceeds of that collateral isn't sufficient to buy back the assets that you loaned out to the entity? Well, that's a potential loss. So, what these agent intermediaries do is they provide this kind of layer of protection where they say, look, if there's a Lehman default and we sell the collateral and there's not enough money to buy back the securities that we've loaned to Lehman on your behalf, then we'll make up the difference. So that's a pretty powerful statement since many of these agents are amongst the world's largest banks. And so that's very good protection. If they're not, then there's other ways that you can protect yourself against it. Some people have insurance policies, some people have liquidity arrangements with their banks. So there's a wide array of how it's covered. But the point is that it can be covered and it's a cost for that agent, right? It's a cost for that agent either. If they're a bank, they might have to put capital reserves. So that might be an opportunity cost. If someone's getting an insurance policy or has a bank liquidity line, then of course there's costs involved in both of those as well. But so there's a real cost. But if you think about it, if you're an investor and you say, well, look, I'm not, I'd like to do securities lending, but what if my counterparty goes bust? And then your service provider says, well, don't worry. What happens then is we'll step in and help protect you. So a lot has to go wrong in order for you to have a loss because of a counterparty default. And that's really what I'm going to go to in that video, how to lose money in securities lending. Okay. But for now, just think of it as a layer of protection. Now, the real question, once that you've determined that your service provider does have this kind of indemnification policy in place, what that means is you have to figure out what it covers. And I've talked about the primary one, replacing the assets you had loaned. And that's really so that you are in the same place that you were before you started lending to them. Now, what about other things though? Because Lehman Brothers went out of business in the middle of September, so that means that there were 15 days of fee accruals. Well, what about that? Some indemnifications cover fee accruals, some don't. What if there's dividends that were outstanding and not paid by the defaulting entity? Again, some cover it, some don't. And if you remember the episodes on cash collateral and securities collateral in the collateral sessions, again, a two-part series, then you remember that there are two kinds. One is securities collateral, and the other is cash collateral, and that the cash collateral gets invested at the risk of the lending client. So even though an intermediary might be doing the actual lending, and making the investment decisions according to a pre approved client guideline, if there's a loss, well, that's a loss for the lender. So most indemnifications don't cover cash reinvestment losses. Okay, so you have to be careful of that. But there are some that do. So, again, good questions to ask. So, indemnification, the bottom line, think of it as another layer of an insurance policy in the event of a counterparty default. Now let's talk about some of the other risks. So we talked about regulatory risk. So regulatory risk really is a risk that there's going to be a change in the regulatory environment, either in your home country or in one of the other countries that you operate in. All right. And that the change has some kind of an impact on the business. So it might increase operating costs. It might make it harder for new entrants to join the market, or it might make it more expensive for the existing participants to continue operating. And then, of course, there's always regulatory intervention that might, in fact, stop the activity altogether, either temporarily or permanently. So let me give you a few examples of these sorts of regulatory changes. One example would be a ban on naked short selling. So this really was first instigated on a large scale in the aftermath of Lehman Brothers. And what a naked short sale is when a trader sells stock that they don't own or a bond that they don't own and doesn't borrow the securities. Okay, so that's because they either can't be bothered to do it, or they forgot about doing it, or whatever the reason, they just haven't borrowed to cover it. Now that's a problem, because if I do a short sale into the market and someone has done a trade on an exchange, they're expecting to receive that from me. If I don't own it, I can't deliver it. And if I don't borrow it, I also can't deliver it. And so now that's a problem, not just for me, but it's a problem for whoever I've traded with, because they're expecting to receive the stock or bond that I sold them. And imagine if Lehman was doing naked short selling and they were supposed to deliver on a Friday and they don't, because they've done a naked short sale, so they don't have the stock. And then around comes Monday and they're out of business. Well, all of a sudden, whoever was expecting that stock on a Friday, they're out of luck. They now become a creditor of Lehman Brothers and they have to maybe pursue them in court. So regulators don't like naked short selling. I don't know anyone that does. And it's an important practice to mitigate against from a regulatory perspective. Most nations have actually put in naked short selling bans since then. And so we have a more secure market since then. There are other markets like the financial, or other regulations like the financial transaction tax, which was implemented in Italy and France, which which puts a tax on trading activity In the case of Italy, it's on equities and derivatives, equity derivatives. In the case of France, it's really on the equities. And that tax all of a sudden has an impact on how people act in the market. And so some people have avoided trading in those markets. And that obviously impacts lending revenue. For example, if there's less short selling activity in a market, there'll be less lending revenue. For investors in that market, that means that they'll make less lending revenue for their portfolios, even if they're available. The biggest example of a regulatory change was the Securities Finance Transaction Reporting Regulation, which is called SFTR. That's a European regulation that came in about a year ago. And that requires market participants that are covered by the regulation to report trades every day, and not just trades, any important life cycle events that have changed. So that gets reported to the regulators every day via trade repositories. And that put in a huge reporting burden and obligation, a lot of expense, a lot of time, and had some benefits come from it in that firms understand their business more effectively than they did before the SFTR regime came in. Nevertheless, it's had an impact on the business. The one that many people are aware of is short selling bans. So we've had short selling bans from time to time. We had them just over a year ago in the aftermath of the market crash, and it's kind of February and March. Those short selling bans came into place in 8 countries, so not that many, but a few important, very active markets. The last of which I think re-allowed securities lending and short selling again at the start of May, and that was Korea. So that's kind of back on stream. Uh, in the aftermath of the Lehman default, though, there were 30 countries around the world that implemented short selling bans for periods of time. And of course, that impacts trading activity of not just securities lenders, short sellers, but also has an impact on normal investors and normal investing activity, because their trade spreads have widened, right? And that's been proven by numerous academic studies that say when there's short selling bans, spreads widen. So what that means is anyone that buys a stock pays a higher fee than they would have otherwise, and anyone that sells the stock gets lower proceeds than they would have otherwise expected. So it has a real impact. Now, interestingly, as I said, after Lehman, it was 30 countries. In last year's market crash, it was only 8 countries. So I think that tells you something about the general direction of the regulatory view on the value of short selling bans. But that's a subject for another video. So that's regulatory risk. The bottom line is regulators can always change things because they have a wider obligation than just to market participants. They have a wider obligation that covers the financial market operations. So they'll always try to act in those best interests. Okay, I'm just going to have a quick drink. As always, I'm with my ever-present Coke of some type. Just a second. Okay, now let's talk about market risk. Now, market risk is really, as the name suggests, so if you think about things that are happening in the market, so the prices of stocks and bonds, the exchange rates, the foreign exchange rates that apply in markets, activity and credit ratings that might have an impact on prices. So what's happening corporately with companies. So there's lots of different market events that can have an influence on the securities lending market in terms of the market risk management of their exposures. Because if I make a loan today to someone, well, that's not just a one off. It's not like if I sell a stock to someone, they pay a price, the trade settles, then that's done. I've got no relationship. Securities lending is the opposite. And this is why counterparty risk is important, because once we do a trade, then everything just begins. And after that trade settles, then it continues. And it continues as long as that securities loan is outstanding. And in the meantime, while that loan's outstanding, market risk and controlling that, or at least being aware of it, is your second biggest mitigant after picking the right counterparties to deal with. So if I lend you a stock and you give me collateral, as we've talked about before, I take extra collateral from you. So it's valued at a higher value than the securities I've loaned to you. And that extra bit, which is called a margin or a haircut, depending on how you calculate it and what your own preference for terminology is, that little extra buffer is meant to protect against intraday movement or maybe even overnight movement. Okay, and the amount that I might take might also be impacted on the volatility of the securities that I've loaned out and the volatility of the collateral I've accepted. So, for example, if you look at a stock like GameStop in at the end of January, obviously it went through the roof, the price, and then subsequently fell. And so if you're doing any kind of evaluation and you only had one loan outstanding, and that was GameStop, well, you might want to take extra collateral there because the possibility of the price going up 10%, 50%, 100% in a day was very real. And so you need to protect yourself by taking extra collateral in those circumstances. So, volatility of securities on loan and the volatility of the collateral that you hold. Now, just a quick point here, this third point about ratings. Now, a lot of people say, oh, this bond is rated AA or AAA or single A. It's an investment grade bond. That must make it great collateral. All ratings are telling you is the ratings agency's assessment on whether the company that issued that bond is able to make interest payments as per the terms of the bond and be able to pay the money back at the end of the issuance, so the maturity of that bond. Right? It doesn't say that there's any kind of a secondary market trading in that bond. It doesn't say that there is any certainty of price. So you have to dissociate the risk that the issuer has in holding that bond or issuing that bond and making payments associated with that bond, and you as a collateral taker, because what you need to be concerned with is, of course, the quality of the instrument. I'm not saying you don't think about that, but more importantly, can you sell it if a counterparty goes into default and if you need to sell it so that you can get the proceeds to buy back the assets? And remember, as we talked about with collateral, it's not just about selling it, but it's about selling it at a price that is related to what you last valued it at. So if I have one loan outstanding for $100 and I've taken a corporate bond and I valued it at $105, and then there's a crisis and I need to sell that bond, but really it's not worth 105 because I can't find anyone to buy it unless I drop the price to 95. Well, that's not particularly helpful to me. That doesn't really protect my risk. So those are the kinds of considerations that you have to take when considering which collateral should be acceptable. Now, the really important thing to me with market risk is that you have policies and procedures in place and ready for all of this stuff, because when there's a default for everyone in the market, right? When Lehman Brothers went out of business, everyone was aware Lehman Brothers went out of business, and everyone that had exposure to them all started taking action all at the same time, or at least they should have been starting at the same time. And so you need to understand what unwind procedures are, what actions need to be taken, who needs to take those actions, and that the collateral that you have is accessible and you can sell it, and that you can start this whole process of selling and buying very quickly. And that's really about policy and procedure and having it tried and tested before an event happens. But even if you take good quality collateral and you have a diversified portfolio and you don't have overly concentrated positions and they're liquid, um, and you have great policy, so you get to you get into action right away. There's nothing delaying you. The truth is, there still may be delays. the stock exchange where you place the orders, they may be overwhelmed with volume, and so your order, which you think you're getting in very quickly, might be stacked up. There might be difficulties in the practical steps of getting control of the collateral that you have. There might be difficulties communicating, or delays in communicating the positions to whoever's going to be doing the trade execution. Okay. So there's lots of issues that may still impact you. And of course, there's the liquidity problem. So if Lehman had a big position in a particular stock, and they gave that as collateral to 10 counterparties, then all 10 of those counterparties are going to be trying to sell exactly the same stock. So there's lots of different issues that you have. And if you're holding money market instruments, money market instruments, very high quality instruments, but they don't really have an active secondary trading market, all of them. And so if you're trying to dispose of an asset into a market that really isn't used to having secondary market trading, you may have to take a pricing haircut. So it's still possible that there may be losses, at which point you may have recourse to the liquidator that's taking care of the liquidation of the defaulting entity. But again, that can depend on individual circumstances. So market risk, to me, second most important issue after counterparty risk. Third, there's legal risks involved because all of this is driven by contracts with your counterparty, agency contracts between the intermediary and the principal lender. I went through the different sets of contracts in the last video on risk, where we talked a little bit about the legal relationships. Um, but but here, these are standard industry documents usually, and that's a really powerful mechanism to ensure at least predictability on what happens in the event of a default. Because what you don't want to do is be surprised when something happens in a default. You want to at least know what your risks are going into it. So, these legal risks, because there's a master agreement used in most jurisdictions, there's a good understanding of what those risks are and how a court will interpret it in each of the relevant jurisdictions. It also sets out the terms and conditions. So it accelerates the obligation. So normally a securities loan, is outstanding until one or the other side returns it. Well, if one counterparty goes out of business, there's nothing to return because they're not in business anymore. So it accelerates those obligations. It also tells you how you're going to calculate the value of the securities on loan and the collateral that's held. And then it will also tell you whether there is an ability to set off those obligations. So in the example, if I have loaned $100 and I've taken $105 of collateral, and then the counterparty defaults, and we go through the legal agreement, and we ascertain what the value of the loan securities is and the collateral held. Uh, if let's say that goes from 100 to 105 to 100 to 103, it actually will say, oh, I can set off those two things. I'll net those two positions. And really, I'm over collateralized by 3, and I have to give that back to the liquidator. And that's a much more effective mechanism to look at what that net exposure is, rather than saying, well, you owe me back all of that, and I owe you back all of the collateral. Okay, so that's important. And in fact, there's regulatory capital penalties if you trade with someone who's from a country where they don't have satisfactory netting and set off infrastructure in place. So if it's not recognized, then it becomes very expensive to deal with that counterparty. Again, there's always ways around these things, different mitigants, different legal agreements, different arrangements you can put in place. But fundamentally, for the majority of transactions, that's one of the risks. Now, no matter what agreement you have in place and no matter how often you test it, there's always a residual risk of what's called recharacterization risk, where even though we consider this a securities loan and sort of temporary transactions, it is in theory possible that some legal system in some jurisdiction may decide that no, in fact, it's not a securities lending transaction, and these two things don't net off against each other. this is a secured loan, and then that might trigger, well, was this securities loan registered with the appropriate entity in that country? And so there's lots of risks there. But look, that's a risk of every legal contract, pretty much. So I would be aware of it, but I wouldn't be overly concerned, because if you have any kind of contract in place doing anything, you're probably at risk of this already. Now, um, cross product risk. What I mean here is securities lending is part of a subsystem called securities finance. And securities finance also includes repo transactions and other margin loan type agreements. And so there is a different range of contracts that could be used. So maybe swap contracts and other derivative contracts that might come to play here. And what happens here, and I'm just pointing out that if you borrow a security under a securities loan transaction and you lend out the long exposure of that through a swap agreement, there could be legal interpretation differences in the event of a counterparty default. And what looks like something here may look subtly different in this contract. So, again, something to be aware of. But again, the good news is trade associations are doing a great job of trying to make the contracts more consistent so that definitions and treatments are the same across contracts. But again, that's a multi-year effort. So those are the legal risks. I'm going to talk very briefly about operational risk. So, as it says here, operational risk is the risk of loss resulting from inadequate or failed internal processes, people, or systems, or something from external events. And that's from the Basel Committee. Basel is the group that puts banking regulations, global banking regulations in place. So it's a super important statement to make. Some examples: trades that are supposed to happen and don't happen, they fail. So that will cost people money inevitably. And that might be from claims, or that might be from canceled trades, but it definitely results in real counterparty exposure. So trade settlement is a problem. Position reconciliation. So I think I've borrowed 100 from you. You think you've loaned 105 to me. Well, that has obvious problems in many different ways. So position reconciliation issues cause problems with valuations and fees and dividend or interest calculation. I mean, just a whole bunch of different problems. And in fact, I will tell you now, there are more losses related to operational issues than there ever are related to counterparty defaults. So this is a really fundamentally important area. If you use incorrect data, well, that's a recipe for disaster from day one. So you want to make certain that your data sources are robust, and that you're also reconciling this with counterparties to make certain that if you're using two different pricing sources, that you identify the issues in between them very quickly and very easily. And of course, if I think you owe me $500 and you think that you owe me $400, well, that's a problem as well. And so again, incorrect fee billing or unreconciled fee billing also leads to overpayments, underpayments, or maybe even write-offs. Okay, so operational risk, very much a key element of the business. Now, finally, I've talked about this a couple of times: reputation risk. Now, one of the reasons that I'm doing this series in the first place is that people don't really have an understanding of the business, partly because the industry's been very opaque over the years. And that opacity means that people don't necessarily always trust it. They always look at it with a little bit of, a half closed eye, and a little bit of a squint, the way that I'm doing now. And then when they hear about tax evasion, like the CumEx dividend scandals that are being prosecuted in Germany and elsewhere, and they hear the word securities lending attached to that, they go, "See, I told you, I knew there was something questionable about it." And here's a perfect example. So reputation risk is really important, because remember, for investors, this is an optional activity. They don't have to do this. They earn money if they do it, but earning money on its own isn't enough of a reason. They want to make certain that there's not going to be any kind of blowback for them being part of the business. And so I've put down kind of three different key elements that I think help mitigate reputation risk. Number one, that you have business integrity. So you need to make certain that that the practice is allowed in the markets where you're actually doing the lending activity. Secondly, you need to understand the rules around tax avoidance, tax evasion, and how tax relates to securities lending. There's sort of maybe five or six different things that relate to tax and securities lending, which you need to be aware of. And you also need to make certain that your counterparties are able to be involved in this business. So it's not just enough to say, well, it's allowed in this market. You need to say it's allowed. The tax environment is satisfied itself that it can be practiced there, and the counterparties and the clients that you have, you're all able to actually do this business. So the whole sort of really it's kind of know your market or know your business as opposed to just know your client. It's about knowing what you need to know to enable you to feel comfortable that you can practice the activity. Secondly, there are best practice guidelines. So there's trade associations that put out best practice documents. There are regulators that put out best practice documents. And an example of that in the UK is that the Bank of England has a money market code. And so you would question your service providers and counterparties whether they follow that best practice. And then the final bit to make certain they have reputational risk, that if you've satisfied yourself that you're doing the business where you're allowed to do it, that your counterparties and your service providers are engaged in best practice, then you want to make certain that there's operational efficiency to make certain that there aren't problems while it's going on sort of day to day. So very much operational efficiency is a critical part of it. So that's reputation risk. Right. So those are the six risks. I've managed to do this one in 40 minutes so far. We're not quite done yet because I really just want to do a recap of the individual risks for these and what those mitigants are. So again, from a counterparty, you want to take a look at good, strong credit analysis of who you're going to be dealing with. You want to have a diverse group of people that you are trading with. It's this from a lending point of view, you have the intermediaries and the clients themselves who both have to agree on this set of counterparties to deal with. So you're really whittling down a big universe of potential counterparties into a select few. Secondly, from a regulatory point of view, like the reality is regulators, as I said before, have to act in the best interests of a wider group of stakeholders than just securities lending market participants. So the best way to mitigate the risk of anything unexpected happening is to rely on your organizational support and infrastructure to make certain that you're always engaged with those regulators, that you're sharing your own points of view as to what you think is good for the market, bad for the market, and how things could be improved. So engagement is the key there. We talked a lot about the market risks, so over collateralization, the daily revaluation of the loans and the collateral. We talked in the collateral section about the reinvestment of cash collateral into instruments that both the investor can invest in, is willing to invest in, and the agent is able to follow their procedures. If we let me just move that. I see that's actually in the way right now, so I'll just change the screen. Oh, hold on. Need to get over to the right screen. There we go. There we go. So hopefully you can see that a little better now. So over collateralization, daily mark to market, reinvestment of cash, and the key thing for me always is the liquidity of the collateral that you're holding. Liquidity is key. From a legal perspective, I think it's important to understand that there are standard industry agreements that are used in most places. The most commonly used one is the Global Masters Securities Lending Agreement, the GMSLA. That gets tested by the European Trade Association, ISLA. They validate that every year. so that they know it's enforceable in the countries where their members want them to check. And there is sort of continuing cross product industry engagement, which kind of standardizes. That's why I was saying, this risk of trading two different products and having it treated differently. That the risk of that over time is lessening. It still exists today. It's still a real risk, but it is getting better. If we then go into operational, so the operational risks really are managed by increased automation. So whether that's on trade execution or post-trade reconciliations, automation is the key. There might be between 2 and 3 million transactions outstanding on an average day globally, and you can't do that manually, obviously. And where you haven't reconciled those positions, that's where risk lies, and that's where potential loss lies. So more automation is always a good thing. And then we talked in the collateral segments about the outsourcing of collateral management for securities to third-party providers, tri-party providers, and how they're really an essential part of the ecosystem for the business. And then, of course, the lender, whether it's an investor or their agent, all of this is very customizable. So you can set up a program that satisfies exactly what you want to have, how you want to have it delivered to you. So those are the 5. And then finally, the reputational risk. We talk about business integrity, the following the best practice, and the operational issues, for example, avoiding fails, buy-ins, okay, because those are the things that most obviously cause problems. So those are the risks and mitigants. As always, if you want to learn more, we have our free primer. So that doesn't go into as detailed level here, but it's a much more of a macro overview. So if you want a macro overview of the business from beginning to end, that's quite a good document to go through. That's available online, on demand, and free. If you're really keen on securities lending, we have our paid-for course, 8 lessons plus an exam. That gives you continuing professional development credits as well. And again, that's online, on demand. And if you want, there's also additional live coaching that's available for people as well. You can see all of that on our website, www.pierpoint.info and /courses. So if you're keen on that, check it out there. So let me just summarize, and we'll go through these, the 6 risks. So first of all, there's no risk without, or no return without risk. Is there risk without return? Yes, you can have risk without return, but you can't have return without risk. But the truth is, the securities lending risks are well understood. The business has been operating for many, many decades. There have been losses along the way, and that's how you actually learn how to mitigate the risks more effectively for future. You find out what goes wrong, and then you change the market practice, change a legal agreement, or make whatever changes are necessary. There are mitigants, as I said, that have been introduced, refined, and developed over time, and that these can be adapted and adjusted at the individual market participant level. So that's the important thing to remember. This isn't a one-size-fits-all business, and you shouldn't treat it that way, particularly with respect to risk. Technology and automation are key elements in reducing that risk and becoming more and more pervasive, and that's a really good thing. And then finally, good practice protects reputations. So that's the summary. Next week, we're going to take a little bit of a break, and we're going to do the half-year stats update. So I'll go through what's been happening with revenues, what's been happening with balances and markets, and anything else that I think will be of interest to you. But that's another week in Securities Lending Fundamentals. Don't forget to check out the full channel, the full playlist with all of the live streams. So that's 9 separate sessions. Remember, again, if you're on LinkedIn or on Facebook, thanks for joining us on that. But the replays will only be 10 minutes long. The full sessions will be on YouTube, on our YouTube channel. That's it for another Saturday. I'm Roy Zimmerhansl, and and thanks very much for joining me.